Hello, everybody, and welcome back to our virtual mastermind series. I'm your host, Jamie Gruber. It's been a bit. We've kind of got away from a little bit of this in COVID because we were doing virtual meetups, but we're back to our virtual mastermind, and I'm excited about tonight. I see some of you out there. If you could go ahead, drop where you're coming from in the chat. It's always great to hear where people are that are watching tonight. Tonight's guest is really, really cool. His story is amazing, which I tell him every time I talk to him, and we'll get into that. But he's going to talk to us about something that might be very, very counterintuitive to many of us that invest out there, and that is forget cash flow. The heck with cash flow. What? Cash flow who? Going to go in a completely different direction, and he'll make his argument on that. But let me give him a proper introduction. The gentleman you see with me today is Mark Hentemann. He's been investing in multifamily since 2000, building a personal portfolio in Los Angeles and a larger portfolio as he's gone into Austin and Denver, and he's always looking at new markets. And after honing his skills for more than a decade, achieving success in both good markets and bad, he started Quantum Capital, and he is the principal of Quantum Capital, which you see on your screen. He's completed well over 50 value-add multifamily investments, remaining passionate about it as a superior investment. His mission is to share his knowledge and help friends and like-minded investors achieve their goals. He also happens to be an Emmy Award-nominated writer-producer who has written for David Letterman, Family Guy, and created shows for Fox and MTV. He lives in Los Angeles with his wife, Lynn, and their 3 daughters. I'm really, really excited to bring to you tonight Mark Hentemann. Welcome, brother.
Hey, thanks for having me.
100%.
That was a good tee up.
Well, that's your you wrote it. So I go with the writers. Whatever the writers write, I just read it. So
all right, very thorough.
So let's dive into that. So you've had this career. You've had this 20+ year career in writing for some big names, Seth MacFarlane now and more recently, and then prior to that, David Letterman. So you've had a successful writing career. In 2000, I guess, right around the time that you started writing, it sounds like you dove in with multifamily investing or starting to invest in multifamily. Why? Exactly. What prompted that? And give us kind of the beginnings of your multifamily or investment journey.
Sure. I guess I'll give you a little bit of background. I grew up in Ohio, and I went to college and majored in organizational communications, but I started a satirical magazine in college and spent most of my time writing articles and drawing cartoons for that. And after school, I moved up to New York to try to pursue a writing career. And I think I got an unpaid internship with MTV out of school and tried to parlay that into the writing business. And I became that proverbial starving artist. I would bolt awake in the middle of the night, panicked over how I was going to pay my rent each month. And, the starving artist thing gets romanticized, but trust me, there was nothing fun about it. And that financial desperation caused me to always be searching for, financial stability as I pursue this career in entertainment. And I did get a couple lucky breaks. I had a stint writing. I was a writer illustrator at American Greetings in their alternative humor department, which was a bizarre job, but a fun job. And my greeting cards, which were all weird, like I was in the alternative humor department as opposed to the conventional humor department. So there was another department that had to service like Ziggy and Garfield. And they had like a manual of 200-page manual on what Ziggy would and would not say. So they had to follow all these rules. And we got to write just experimental, weird, surreal stuff. And that's all I did. And I had no art training, but somehow I was a writer illustrator. So I did that and it was fun, but I knew I didn't want to do that long term. This was a fun sort of stint. How did I end up here was kind of what I always thought. But so I put my cards, after a year at American Greetings, I stuck a bunch of my greeting cards into an envelope and sent them blindly to the William Morris Agency in New York City, and immediately kind of forgot about it. Like, there's no way. The receptionist was so rude. Like, I was like, how do I go about like finding representation, agency representation? She just said, send whatever you got to the mailroom, and just hung up. And so I did send it to the mailroom, and, immediately forgot about it. But a couple of weeks later, I get this call and it was an agent. And she said, hey, it was in the mailroom, and I opened your envelope. And she's like, these are funny. Like, have you ever considered writing for television or film? And I was like, yeah, that sounds great. What do I have to do? And she said, you got to write a spec script, and kind of went through these, the process of getting an agent representation and then shopping your material around. So I was like, all right, that's going to take me about a year to do all that. And I started thinking about it, but she calls me again like a week later, and she said, I didn't tell you this on the phone, but I sent your cards to the Late Show with David Letterman, and they want to meet you. How soon can you get here? And I said, I'll be there tomorrow. And my mom loaned me some airline miles, and I flew up there, and they offered me a job. And so that got me into the industry. It was amazing. It was fun, but I did realize while being in New York that 98% of the entertainment business was in LA. Like, the late night talk shows were in New York. But if I wanted to get into movies and television and other aspects of it, I'd have to move to LA. So my wife and I, she was my fiance at the time, we move out. She gets an opportunity to with her job to move to their LA office. And we move out west, and I take some meetings, and I get an interview on this new show called Family Guy. And this is the year's 1999. And they offer me a job, and I had no faith. Seeing the little like 5 minutes of crude animation, I had no faith that this show was going to last. I thought we were going to be canceled in a couple of weeks. And the trauma of being broke in New York City was still fresh. That experience was still fresh. So I took my first 2 script payments on Family Guy, and I bought a duplex. And I got sort of nudged into doing it from this broker that I didn't know, but that's another story. But I went and showed up at this property, this duplex, and it was in an area called Larchmont Village, and it was run down. It was 1920s construction. It was completely overgrown, and all of the cool kind of architectural detail, which I could see there, was lost. And the owners of it, the sellers of this, were raising goats and chickens in the backyard in the middle of LA. And they were moving to Kansas to live off the grid in an underground, like they were digging a hole and building an underground house. So I blindly, not knowing anything, got into a bidding war on this duplex, and there were 15 other buyers, and I was terrified. I couldn't sleep at night. Every day the price went up 15 grand, and the buyer pool got whittled down. And what was listed at $379,000, I won the bidding war by paying $435,000. Wow. And thought I had just made the biggest mistake in my life, that I was going to be broke, bankrupt, in jail for somehow because of this huge mistake.
Right.
But I tried to move in, and embrace it. And my tenant was Mike Henry, who plays Cleveland on Family Guy, and he made fun of me for being a landlord, and I threatened to evict him on a weekly basis. But we took over this property, and I did the value add. I liked it. I found that I really liked it. I was also reading a ton on multifamily investing and taxation and all that. And in year 1, I thought it was the biggest mistake I'd ever made. In year 2, I refinanced and thought, lowered my rate. I think Mike didn't move out until a year later or so, but in year 2, I thought maybe this isn't so bad. And then in year 4, I think I refinanced a second time, and rates were going down. I think my first rate was like 8%. And then I lowered that to 6%, and then lowered that to 4%. And by year 3, I had refinanced already, And I thought, this is the greatest thing in the world. It was cash flowing. And I'm like, I'm going to do this for the rest of my life. So I sold that after 5 years altogether, bought it in 2000, sold it in 2005. What I had overpaid, this property listed at 379,000. I paid 435,000. I sold it after 5 years for 1.27 million. And I was able to take out the $500,000 married couple tax exclusion. So there was no tax on the first 500. And then I 1031 exchanged the remainder of the gain. And I bought like a 16 unit and another 4 unit. And I was at that point, it was a huge moment for me in my personal life, definitely in my financial life. But I was like, I don't care when the entertainment business decides to spit me out. I'm going to invest in real estate until I'm 100. And I started doing that, pumping all of my money into real estate. And I, to go with the theme of this show, this presentation, is I didn't know that the common conventional wisdom is that you can't really invest in coastal markets or in major cities like LA. I was just doing it. And I was always finding value add. My funds were limited. So I would buy the cheapest properties I could find and I would fix them up. And, invariably, when you're buying the cheapest, lowest cost properties, there's going to be problems with that. There's going to be issues, and it's got to be a value add. But I built a portfolio, maybe built up to 14 properties. At the same time, I was telling every writer that I know, I was like, you got to look, our business is so risky, so volatile. We know people that are employed for a while and then they go on a dry streak. Like, do yourself a favor. When you make money, put it into real estate investments. And they were all like, oh, you're so smart to be doing that. Like, yeah, I got to do that. I got to do that. But the thing is nobody would do it. And I don't know if that's the writer temperament or they're kind of fearful, but eventually they said, well, you won't stop talking about this. So why don't you find something? Why don't you buy something and we'll put money into it. And that's how I started, forming partnerships and buying with other people as well.
Raising capital. And all of this, when you say 14 total properties, the 16 unit, the 4 unit, all of this is LA, correct?
All of that was LA. I didn't branch out until 2016.
Into Austin. And so now from a cash flow perspective, and apologies if I missed it, because I know the title of this webinar is Forget Cash Flow. But was there any? Were you just sort of breaking even on the property essentially and just, riding the wave of appreciation? Like, was there any cash flow whatsoever, the smallest amount, or was it pretty much, kind of a break even scenario?
I can't even remember, like that first duplex that I bought, I did not factor cash flow into the equation. And that was dumb. I mean, I wouldn't do that now, but I knew there was a tenant next door. I think they were paying $1,700. So I was getting $1,700 a month, but I had just paid $435,000 for this thing. And it helped, but I was employed at the time. I was on this new show, Family Guy, and I was getting episodic fees and script fees. So this was just me naively trying out real estate with this investment, hoping that it could somehow provide me with a financial cushion. And what my plan was is when I'm unemployed, my plan was that when I become unemployed, I'll just live in this duplex and, having a renter there will help. And I think that happened in like year 3. In year 3, I realized that all of my mortgage and taxes, property taxes and expenses were being paid by the other side, and I was making a bit of a profit. And that was a huge moment. I was like, okay, now I can get fired.
Right. Yeah, you'll be able to survive, right?
And I'll be able to survive, which was just the source of so much anxiety.
That makes sense. And so we're going to dive into this topic of cash flow versus, I guess, not, or at least not investing with the cash flow. Cash flow is the primary factor in mind. For the folks that are out there, one thing I'd like you to do is change your chat box, open up your chat box, change it to everyone as opposed to host and panelists so everybody can see it. And as we go through this, as Mark talks a little bit about his investing criteria and how he invests and where he invests and all of that, drop questions and I'll make sure to grab them out of the chat and ask Mark those live as we go through. So open forum. That's the point of why this is live. We're going to record this. It'll be posted somewhere later, but it's a chance for you to get your questions directly answered on this topic, because again, it is a bit countercultural to the whole real estate investing realm. So let's just dive in. Simple question. Why not cash flow? Why do you invest how do you invest if not for cash flow, I guess? What's your strategy? Kind of walk us through
For
that.
me. And yeah, I know, there's no more venerable book in the real estate investing space than Rich Dad, Poor Dad by Robert Kiyosaki. And that's the Bible. That's the Bible for cash flow. So this is my backwards way of my backwards experience. I am in LA. I'm buying the first duplex I bought. I made a 2,000% return on investment on that first duplex. And that was over a 5-year period. And that was pure ignorance too, which is ironic. Like I've never equaled that return, a 2,000% return, even when I got more and more experienced. So I don't know what that, what is, Warren Buffett has like some quote where it applies to real estate, but he said it's, investing is not a business where a 120 IQ beats or where a 180 IQ beats a 120 IQ. It's just do it. It's pretty much, you don't have to be a rocket scientist.
Right.
But
yeah, absolutely.
As I was investing in LA, I was seeing these like phenomenal returns that I was getting. And this was at a time when there was not much social media around real estate investing. And I didn't know any other investors. I didn't know that, the conventional wisdom was you can't invest in coastal markets. I actually liked that I paid a lot of money for just a few units, because I realized that I don't want economies of scale. I want the opposite of economies of scale. I want to pay, if I'm going to spend $5 million, in this lasts to this day, like if I have $5 million to invest, I would rather buy this is exaggeration, but say a 10-unit building that costs where it's a $500,000 a unit price, than buy a 500-unit building for 10 grand, because most of my money to go towards the land, because the land does not break down. The land does not have plumbing that deteriorates. It doesn't have the expenses. I want the least amount of expenses. So that was one of the things I liked. I liked buying expensive units because there was a merit to that. There was virtue to doing that, because you didn't get hit. Like a plumbing leak can't kill the cost of that unit. Like if you're investing in a rural area and you're picking up a unit for 10 grand a unit, you could have a plumbing leak that costs you 10 grand, and that wipes out your whole what you cost. But if you're spending 500,000 a unit, the expenses almost become negligible, because there's so much as a percentage of the value of the unit. They're tiny.
That makes sense.
And I'll go on to another point. One thing, as I was investing in LA, the other thing that I was doing is, it goes to that one thing by Gary Keller, is I kept asking myself as I was investing, and I have invested in probably 60 properties over the years. What is the one thing that contributes most to overall return?
Yeah.
And I ask that on almost every deal that I do. And what I found over time was it wasn't the cap rate. It wasn't the cost per unit. It wasn't cash flow. It wasn't leverage. It was, where is the property? And it sort of led me back to, if I invested in a strong growing market, and with a lot of other factors, with a diverse economy, in an expensive market, I would walk though that was the number one determinant of overall value growth.
Gotcha.
And
Yeah,
ironically,
location.
I was like, oh yeah, isn't there some saying about this? And it's like, and ironic, and it's a joke. It's what are the three most important factors in real estate investing? Location, location, and location.
Exactly. I'm smirking. People are noticing because I hear you. I hear you battling that leaf blower.
Yeah.
This
There's
is
no way you can't hear it now.
It's about entertainment. We've got the writer, the TV writer. This is good entertainment value. So it's not bad for me, but I can see you trying to kind of get
Yeah. Murphy's Law. They never, I don't think anyone has ever been standing 4 feet away from me.
It's almost like somebody paid him to do it.
Right.
Just stand by the window blowing the leaf blower.
This is a bit.
That's awesome. I'm getting all these private messages. We could see you. We could see you trying not to laugh. But it's fine, honestly. It's not coming through as much as I could tell it's bugging you. It was more funny for me on that end. But all right. So location is how you make the determination of value. We have this question here that I'll pivot to, and we can go down this rabbit hole or we can come back because I have other questions. But is it possible to get a bank mortgage? Or I guess a bigger question, like, how does financing work when you're in maybe a negative cash flow, or maybe the debt coverage ratio is below a 1.2, or is it? How does bank financing work for you in an expensive market like that? What hurdles are there, if any?
Yeah, there are hurdles, and there's also benefits. I think what I experience is I try to invest at about a 70% leverage, 75 if I can get it. My goal is 75%. I don't really go for 80%. I don't want to get over leveraged, but I try for that. I think a couple factors are when you're in a prime market, and I think a market that, oh, there we go. They finally finished the leaf blowing. When you're in a market that's considered an A grade market, the lenders will lower their criteria because it's a strong market. So the lenders are risk adjusting this in they regard prime markets as, markets that have a diverse economy, barriers to entry, growing populations, so if you're in one of those A markets, they are more flexible on the debt and they're more willing to lend in those markets. So that compensates for some of the lack of debt coverage ratio.
That makes sense.
And my experience is that I usually hit between 65 and 75%.
Oh, for
LTV.
debt LTV, right? Yeah. Okay, gotcha. Yeah. I thought you were saying that you're getting that for debt coverage, like below a 1. Like, wow, that's pretty good.
Right. Yeah. No. Same. Like, what is it? 1.2.
1.2 is typical, but that's where I am. Like to your point, they may adjust that down slightly, 1.15, 1.1, something like that. If it's a prime market. Well, in that regard too, so prime markets, for those that are less familiar with the idea of like what cap rates are, I don't want to just ask this question without context, but cap rates are very low right now. Cap rates being the capitalization rate, expected return if you paid cash for the property is the best way I know how to explain it. And cap rates are low everywhere. I mean, everything's a 4 cap right now, a 6 cap. It doesn't matter where you are. Everything's low cap rates. In a place like LA or Austin or Denver, who have very low cap rates, I'm assuming 3, 4 caps at this point is probably where things are trading. What happens? So you buy a property today, you're maximizing the return for the investor, and we'll get into your criteria for investors and what you do. But what does happen if in 3 or 4 years in, if you're still holding a property, coming up maybe against a term, and cap rates expand? How do you mitigate that, or how do you adjust the risk of that? Or do you, in a market like that, I'm maybe not be familiar in New York and LA and Austin, is it just really not as big a consideration? What are some, I don't know, back end hedges or back end mitigation strategies you might have on that?
We build cash flow as we own it. So sometimes we'll get in at very low cash flow, but then as we own it, one of the nice things is one of the phenomena of being in a really competitive market is that rents are going up. You're seeing rent growth. And I think that's one of the things that we invest for. We don't invest necessarily for cash flow on day one, but we invest in growth momentum is what we call it. It is what we've kind of evolved our philosophy and our strategy to be, is we want to be in growing markets with growing rents growing incomes, growing populations, and we leverage that. So we'll start off thin in terms of cash flow, because in cash flow, everyone should know that cash flow is a function of demand. So, cash flow is inversely correlated to demand. So if in a market where 100 buyers show up for every property, that cash flow component is going to go downward, and your cap rate's going to go down. But where if you're in say a tertiary market or a rural market where there's fewer buyers, you might be the only buyer. That's where the cash flow goes up. So what we do is because we're in competitive markets, there's a lot of buyers competing for these deals. So the cash flow is very thin, and the cap rates are compressed. But over time, by year 2 and 3 and 4, we're seeing rent growth. And so our cash flow starts to flourish and sort of flower in year 2, and then we're adding value add on top of that. Usually by the end of year 2, we've completed our value add renovations, and we've experienced rent growth as well. So by year 3, we're in a pretty strong position cash flow wise, and we're still locked in on our original loan. So by the time we're ready to refi, we have strong cash flow, and we can potentially we can decide whether to refi at that time. Does that make sense?
It does. Yeah, it does. And I'm looking, a couple questions popped up. I'm just looking at them in the chat here. But filter the rent opportunities. We'll come to that question here in a second. How then do you find, because to your point, you're in an expensive market, you build cash flow over time. How do you, because you've done a lot of deals, and you've done them in markets that many people would say are just too hot to touch, right? At Denver and Austin and LA. How do you identify the kind of property that you are able to invest in so that you can execute on the strategy that you have? Like what's your criteria? How do you execute deal flow, especially as you enter new markets? Can you just give a bit of a rundown on that? Like as somebody who might be looking at, all right, if I'm looking at, Quantum and Mark and what he does, like how do you find what you find? How do you get what you get? What's the criteria you use? And then how do you find the deals?
Yeah. So every market is relative. So I think one of the first things that you need when you're going in, and I've been fortunate that the 3 markets we're in now, LA, Austin, and Denver, we have a partner who lives there and grew up there. So we know those markets really well, and they know the lay of the land from neighborhood to neighborhood. So we don't have to do scouting for, what is the median income? What is the crime stats of this, block to block? We know those markets, but what we educate ourselves on and study a lot is like, where are cap rates? So we start off by looking at every deal that comes across our desk or that we can get our hands on, and we look at where they're being priced and where they're trading, and then we wade into that carefully. Like we start making offers, and we try to use our reputation. We try to leverage everything that we can, our experience, our reputation, our liquidity, our portfolio, to get the best price. And we negotiate pretty hard. And yeah, we build broker relationships as well. But yeah, I think a really important factor is understanding where things are trading in that market, and know the market. Like, we wouldn't be in the market unless we saw a bunch of arrows pointing upward across, the population trends, the income trends, the rent trends. We want to get into a market. Like I said, we want to leverage growth momentum, and we want to get into these markets that are growing, the strongest growing markets in the country. And we want, things in addition to just the growth things. We want to see, major universities in there that are spitting out, graduates who will stay there with, high paying, with graduate degrees and MBAs, and that will remain in that market and build and make that market stronger. We want to see barriers to entry We want to see seats of government. Boston or Austin and Denver have both of those. They're both the state capital. So all those things create a really diverse job base and create a really stable and dynamic and growing growing market that we can get into, and we just fight to get the best price we can, and we want to see ourselves buying it below where other properties are trading, and then we kind of feel comfortable.
I like it. Jordy's got a good question we're going to come to here in a second, but on that topic for a moment, you mentioned Denver, you mentioned Austin, location, right? Everything you've talked about, really investing for appreciation and cash flow that builds over time. Maybe not that I paid $25,000 a door in Michigan and, you cash flow X, Y, or Z, right? Your strategy is more location based, appreciation based. What about LA, especially with COVID? Like all the news, and again, the news is, they tend to zero in on like one particular thing and make it seem bigger than it is. But a lot of talk about population movement out of LA, a lot of talk about, migration patterns out of LA. Have you found that? Have you seen that? Are rents still stable or going up in LA? Like, does the location strategy still work there? Or is that a market that might not be quite in the same pantheon now as an LA or a Denver or an Austin?
Yeah, it's interesting in watching LA. I think in what I've read, I've kind of dug deeper into the population trends in LA and what is happening, which is, maybe unfortunate, but just it's the reality is I think there's some percentage of the population that is seeking more affordable housing outside of California, outside of LA. But at the same time, there's an influx of MBAs and tech workers and people with higher paying jobs are arriving. And there's still the phenomena that the top of the MBA classes still want to be in dynamic markets where they'll meet and network with, the people who are doing the most exciting things in the business world, because that's where they want to be, and they want to be within that pool. So, I'm watching LA. I think I got very lucky that I think between 2000 and 2020, I think Marcus and Millichap came out with a report on just looking back. I think when we hit 2020, and the LA Orange County market had the highest appreciation of any market in the US during that 20-year span. Yeah. But I think I would guess that it's lost that spot at this point. I think the tech base is still growing in LA. I think the entertainment business, like some of the key employers are still thriving and growing. I mean, the entertainment business has brought, it alongside of Netflix, like now Amazon wants to get into entertainment production, and Apple is in entertainment production. So they all want a big presence. So it's interesting to watch. I will be honest that I'm watching LA carefully, all its demographics, but I think where we are, the tier that we're in LA is affordable housing. And this is how I stumbled into that when I had very limited funds, and all I could afford was like B and C class. But I would always make sure I bought B and C class in like central core, prime locations. And I liked those buildings because, like I said, when I bought the cheaper buildings, they inherently had a value add aspect to them, and they were if they were well located, I thought, wow, if I could take the C class and turn it into a B plus, and the location is great, that's the best I could ask for. Yeah. So we're still doing that. We are very selective. Fortunately, I've been in LA for now 22 years, and LA has 100 submarkets, and those submarkets, some of them catch fire and some of them have been hot. And then what happens is that everybody wants to live in those hot markets, but they get overpriced. So I usually try to get ahead of everyone else and be on the perimeter of those, like Silver Lake or Los Feliz or some of those like really cool, hip and vibrant areas.
Yeah, I just from conversations we've had, I've always appreciated, there's a couple of things. you really kind of tested your theories for years before you started to really start taking on, big, and you've always had your friends in the industry that you've helped and all of that, but you've tested your theory for years before taking on investors. Like you said, you're in the markets physically. You or a partner are in the markets physically that you decide to invest in. So you've got boots on the ground, you've got knowledge of the market. Thoughtful, I would say, is the approach that you seem to take to the types of properties you purchase and the investments that you make. Is that fair?
Thank you. Yeah, I think so. I think as I compare myself with other writers, I think there's an element of me that doesn't have the fear that other people do. Like I am, because I don't, I think, God, what's that guy's, what's Free Solo, Alex Hanault. If you guys like that documentary, Free Solo, he has some comment. He said, people say I'm crazy for doing this, but I consider myself risk averse. This is the guy that climbed El Capitan with no ropes, with his bare hands.
Yeah,
and
I did hear about him. Okay,
which is an insane, the only person who's ever done that. And, so many climbers have fallen to their death trying to do that. And he did it. And he said, like, I consider myself risk averse because I plan so carefully for it. It's just every move is an easy move. From this rock to that next rock is an easy move. Mm-hmm. And so when I heard that, I was like, yeah, I guess, I'm willing to take risks, but I prepare. I guess maybe that's the thoughtful part, is I prepare for how I'm going to do that and, mitigate risk as much as I can.
That makes sense. And I want to talk a little bit about you, back to the LA point about, what you hear in the news, this, that, and the other. Before I moved to Michigan, all I knew was there was dirty water and people were getting shot. That's all I heard, right? That was the news on Michigan. Then you get here and you're like, oh, wait a minute. I see traffic and prosperity and, like, go downtown. There's some cool spots in Detroit or whatever. It wasn't what it's made out to be. That totally. Microscope was gone, right? So, I to your point about, like, oh, everybody's leaving California, you have this picture of, like, people walking across the border of the state in their suitcases in droves, and it's people have left, but other people have moved in. And to your point, LA is so dynamic, and it's in such a I don't know, it's such a great spot, even just physically. It's a beautiful area that, it's one of those, maybe it's going through a transition, but it's like New York, it's not going down. But let's just go into. Oh, go ahead. I'm sorry.
I'll wedge in one small comment is that LA will always have an affordability issue. So I think that's why I like to be in the affordable tier of it, because there's also a lack of housing. There's just not enough rental units. So I think when you stay, I don't know, my sort of strategy is to stay in that affordable tier. And I think maybe other tiers of the rental market may get hit. I've been investing since 1999, and experienced all kinds of things. I experienced the .com crash, the 9/11, the Great Recession, all kinds of recessions and those kind of things. And I've noticed how the A class takes big swings. They get really frothy in good times, and then they drop precipitously when the economy goes bad. Whereas I held, I had all B and C class throughout the 2007 to 2012, and all those properties stayed full and the rents held just because people were moving down to those. So I kind of like that tier of the market. And even if LA experiences some, like, population decline, I think there will always be high demand for affordable housing.
Makes sense.
And I keep rambling on. And I like that, we're kind of serving some kind of social good by, our renovations refurbish the stock of affordable housing.
Yeah, and without getting into too many specifics personally, but I know how much you're a value-focused individual, which that just speaks to, right? That you're serving a certain niche, you're providing a service for people that may not be able to otherwise afford housing in a city like LA. So do this for me. Line this up for those on this cash flow versus not cash flow investing thing. Let me just kind of paint this picture for you. I think we can do it this way. let's say somebody comes to me as an investor with an opportunity in Michigan, Ohio, Midwest market, 50K a door, this much cash flow, 8% pref, yada, 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 right? Whatever the hold is without getting into all the terms. And then you come along and say, hey, here's my offer for this, $250,000 a door, 100 unit in LA. I've got a 3-year-old walking in, so he might make some noise here. Give me an idea of what that looks like from an investor. As an investor, what do I expect that to look like from one side and then from your side, if you will? Apologies for that.
I think they would look pretty comparable. I think our OMs, our offering memorandums, are very comparable to a lot of others in terms of what the IRR is. We invest in growth. So we're investing in the growth of value. And although we may not have cash flow on day one, we can structure it so that we can make distributions to investors from the get-go. And then at the same time, we're adding value. And I think the difference is that another investor who invests in, say, a rural, or I say rural, but maybe tertiary, just a much more higher cash flow, low cost market, I think what they would see in what an investor might, kind of look for is they may see high cash flow on day one, and they would see smaller rent growth every year, depending on where they are. But I think if they're not in a really competitive market, rents go up just like prices go up. It's all based on competition and supply and demand. You can get a lot of cash. If you get a lot of cash flow up front, that means there's not a lot of demand. If you understand, the dynamics of cash flow. So you are likely not to see the rent growth every year. It'll just kind of be more flat. Whereas if you're in a really hyper competitive market, and you don't have to be in the ones that we're in, those are 3 examples of high growth markets, but there's others too. There's, everybody is kind of aware of them now. I like Salt Lake City. I like some, Atlanta is doing well. Where else? Boise, Idaho is somewhere I want to invest as well.
Yeah.
But when you're in those, you're starting out with lower cash flow, but it's on a steep, the curve is steeper because there's so much demand. You're going to see rent growth each year, and that's going to drive the value up, and you may see more competition as well.
Yeah, makes sense.
Did I?
Yes. Yeah, absolutely. No, you invest in these markets. You see the growth every year that you won't see in a market like in the Midwest. Essentially, you will see hyper growth in rent every year as a result of just being in the right market, as opposed to in a growth market, as opposed to being in a Midwest market where it's relatively flat, essentially.
Yeah. And I love the Midwest. I'm from Cleveland, from Ohio.
You're trying not to degrade it. You're trying not to degrade it too much.
No, I would move back to Cleveland.
No, you're a writer, not a good liar. Not a good liar. So no, I'm just kidding. We have a question out here. Look, on the cash flow question, I think I've got a really good feel. If there's more questions on it, please drop them in the comments. But we have this question from Jordy, who is a GoBundance member, by the way. I don't know if you've met him yet.
All right.
Do you ever look at infill build to rent opportunities, and why or why not?
I do look at infill. I mean, infill is kind of was my strategy. I think Can
you explain that real quick, what infill is for those listening? Sorry.
Infill, and I don't even know if I understand this. I just assume infill is in urban markets. It's, instead of spreading outward, it's taking advantage of unbuilt land in the city, in the core. You're kind of staying in the core.
Got it. Yeah, I'm Googling it. Got it. Yeah, that's a pretty good explanation. Yes.
Did I get anywhere close? Because I don't think I've ever seen a definition of that.
Is the relocation of land in an urban environment usually open space to new construction?
Yeah. Utilizing the space that is already there. In LA, my first target was Hollywood, and then that was a dump when I got out to LA, and I was surprised. I was like, isn't Hollywood like known around the world? Like, isn't it a brand? Like, shouldn't LA take care of this? All the history that's there. And shortly after that, like, I saw that there was like a $10 billion fund from a bunch of business leaders to revitalize Hollywood. So I wanted to get in on that. And then downtown used to be, nobody lived downtown, but then they totally revitalized that. There's a lot of tech downtown. And so I was drafting off of that in some of that urban infill right adjacent to downtown.
Interesting. So you are looking at it, it sounds like. Have you gone how far have you gone with it?
Oh, with what? Infill?
Infill development. Yeah.
Oh, no development. I would love to do development if I find the right partner. That would be fun.
Gotcha.
But I got my hands full with multifamily. I like multifamily. It's easy. We did buy a property in Denver a few months ago that we're planning to redevelop. We have a whole city block in Denver that only has 16 units on it currently. There's 16 bungalows, and I think it will accommodate like 48. So
amazing.
I'm going to try to do that.
Very cool. That's amazing. We have another LA question. LA investor here. This is from Adele. Been investing here for 7 years.
Oh,
Can
cool.
you talk about how you explain to your investors about your experience dealing with the animosity toward landlords in California?
So explain to my investing how to deal with the animosity towards landlords.
Yep.
Yeah, I don't I don't know. I don't experience it directly. Like, it seems like legislatively, obviously there's rent control. Rent control is kind of the main thing. I think maybe there's a general vibe amongst, some tier of the population that's anti-landlord. But then there's also, some of the biggest landlords in the country are in LA, and there's a huge and significant real estate investing and development community throughout California. But the one that everybody's aware of is California has rent control, and that's a whole nother story in itself. But my experience with it is, all rent control does is it distorts the efficiency of the market from an economic standpoint. It creates these dislocations in pricing and in rents, and a savvy investor can take advantage of that and see opportunity in that.
Given there's another question on rent control, another California investor. Can you give a quick example of how? So, and I want to make sure I understand the rent control piece. This is where legislatively, I should say understand, but we explain it. Legislatively, there is a cap on rents and a cap on what you can raise rents to, at least for existing tenants, correct? Or certain units?
Correct.
Is it? Okay. So
Right.
How do you deal with that? Like you just said, there's a savvy investor. Can you give maybe 1-2 techniques, hacks, things that you've seen around how an investor would deal with rent control and maybe explaining that to an investor?
I think what rent control does is it scares away a certain percentage of investors, as you guys could probably all sense. Like, there's a portion of the investor market that just won't deal with it, and they don't want to learn it. They don't want to try to tackle that. And it's scary. But the truth with rent control is, you may have, say, a 10-unit building where 10 one-bedrooms, they should all be $1,800 a unit, but you've got 5 units that are paying $700 a month. And that's the distortion. There's no economic efficiency. It's not optimized. And so what you can do, there's always natural turnover. So you could buy that property, and what I advise anybody to do, buy it based on its current income. And so I don't pay as if I'm getting $1,800 for that one bedroom. I pay based on a $700 income underwriting. And so you do that, you stick to your guns on those things. And luckily, like, LA has a ton of inventory. So there's a lot of properties, and that's another aspect of it. It's the opposite of Austin. Austin has such limited inventory that, it feels like there's only 12 properties on the market at any given time. In LA, there's maybe 10,000. Like, LA has 20 million people in it, and it has 3 million parcels of land. And I think, a good portion of those are multifamily. So there's a ton of inventory.
It's interesting. I have some stuff in New York. I've sold off a little bit upstate, not New York City, but duplexes, singles, that kind of thing, right? And New York imposed this, you can only raise rents a certain percentage every year. And, it's more of a sign of what is to come, likely, like more legislation, more rules that hurt landlords and all of that stuff. And I get that. But man, you saw this pullback. And in this particular town I'm investing in, it is a cash flow town, inexpensive property. You can cash flow a ton, buy for $80,000 and 2 units rent for $1,500 each a month, right? Like ridiculous. But it'll be $80,000 in 10 years. Like it'll be the same price today as it will in 10 years, right? So the opposite of what you're talking about, and you're convincing me the other way. But people drew back on that. And to your point, to me, that's like the opportunity to buy. That's the time to go in and say, well, I'm not going to raise rents more than 5% a year anyway, likely. So I can now buy this inventory that's been, sort of marginalized because everybody's afraid of the news, if you will, and roll through. So I think there's a little bit of what you're talking about on a grander scale with LA.
Yeah. And so I benefit from that, maybe 15 times a year, or if not more than that. I get a email from my management company. Oh yeah, the tenant in unit 4 moved out, and they were paying $600 a month, and it's a $1,900 a month unit when you turn it. And so there's this huge jump in rent on that one unit. And if you can do that across a few units, and then you can also, another strategy is it's legal to offer buyouts, and you actually go through the city, but you can buy out tenants. And I'm in the process of doing a couple of those. I'm always doing those. Is if someone's got a unit that's, say, $500 and it should be $2,000, and I can make $1,500 a month. If I can bring that to market, I'll offer that tenant 20 grand, 25 grand to move out. And, it's totally legitimate. You send the paperwork to the city, they stamp it up, they rubber stamp it. And then, that tenant walks away with 20 grand, and you've now just added 180 grand in value to your property by that rent increase, that one rent increase.
It's a great point. That's a great point. We only have a minute or two left. A couple things I want to do. I have a really big question I want to ask you. I haven't told you I was going to ask you this question, but it's a biggie, and I think people are going to be floored by the answer. But it's called an open loop, right? An open loop.
Okay.
But before we do that, where can people learn more about Quantum, about you, about what you're doing? How can people find you and learn more about your company?
Sure. You could look. We're at quantumcapitalinc.com. We've got, you could see what we do, see some of what our current investments are. And we've got a couple new ones coming down the pipeline. And you could also check out, I have a podcast, The Wild West Real Estate Show.
You had a great guest recently. This really cool bald white dude.
We did.
Yeah.
What did you say?
A bald white guy, I don't know, they call him Little Sexy, or at least I do. I don't know, but yeah, you can watch that or check that out. So Wild West, mini me, I just saw it down here. So no, that's great. Yeah, check out the website, and there's so much. Again, there's so much value here. What we're going to try to do, if Mark is agreeable to this, is try to bring him back. This virtual mastermind series, we run the second Wednesday of the month. So come back second Wednesday of September and October and November. But at least coming up, maybe next month, we're going to try to get Mark back and dig deeper into some of these specific topics around investing. But I'm gonna insist we get you back at some point.
I'd like that. Yeah, there's more to talk about too. So maybe we do. But I know you got to go, and I promised my daughter I'd have dinner.
So here's the last thing I'm going to ask you, and you can answer this as quickly as you need to. You can answer this in 2 bullets or 3. How many times have you been hit by lightning?
Exactly 1 time.
And where was this?
I was a caricature artist at SeaWorld in high school. That was my job. And one day, it was in Cleveland, Ohio. For all you Michigan people, maybe you've made the trek down. It's a little bit past Cedar Point. You go a little further east, but actually it doesn't exist anymore. There used to be Geauga Lake and SeaWorld were in Aurora, Ohio.
Right.
And I was drawing caricatures. One day, a summer storm came in, and we caricature artists got sent home. So my 2 fellow artists, we ran into the Shamu souvenir shop and we grabbed umbrellas. So we were, and then ran to the employee parking lot, which was like a quarter mile away for anyone who worked at an amusement park. You never get to park anywhere near the park. So by the time we got out to our parking lot, we were holding metal rods and standing in about 6 inches of water. And we got zapped. And I just felt this bolt of the most intense experience coming from my hand and going out my foot. And, we all kind of face planted in the water. And then I was 18 years old, and we all kind of looked at each other and we were like, that was awesome.
That's hilarious. Maybe it's what led to your brilliance, your writing brilliance is that bolt of lightning. You never know. Mark, thank you so much for being on tonight, man. Always appreciate it. Great connecting with you. I'll see you in a couple of days here, actually. I'm looking forward to seeing you.
Likewise. Yeah, so, that'll be fun.
Yeah. Safe trip. Go be with your daughter. I got to go help put the kids to bed. And guys, thanks for joining in. Check us out again next month on this series. Go ahead.
Thank you to your whole group. Thanks for tolerating me and my crazy theories.
You got a bunch of thank yous coming out here. Nobody's thinking it's crazy. I think you got them all bought in. So we'll continue to convince them. All right, brother. Appreciate you. Thanks, everybody. We'll see you all in a month. See you, Mark.